Let's get across the market open now. Chris Weston joining us from Pepperstone. Chris, welcome to Tuesday. We look at what happened on global markets overnight. A bit of a pullback there, particularly, I guess, some profit taking among tech stocks, but oil proving to be a big drag again.
Well, I think the oil price was the first derivative of everything last night. I mean, if you overlap the S&P futures or Nasdaq futures relative to the Brent crude futures front month, you basically saw an almost perfect inverse correlation. So where Brent went, the S&P did the similar situation or the opposite situation. So I mean, it was a whippy session. I mean, if you have a look at Brent prices, we traded lower for Asia, and then it was a bit of a rally, and then towards the tail end we got those headlines that Trump was on the instructions or the advice from various parts of the Gulf, the UAE, Qatar, and the Saudis that that things were ticking along a bit better, and he said that we're going to delay this attack on Iran, and the oil price fell, and we saw equities have a nice rally into the close, and we closed pretty flat on the S&P, but I think it was really a move there. I mean, earlier in the session through Asia yesterday, all we were talking about was fixed income and bonds and long end rates, and what was happening in the JGB markets, what was happening in UK gilts and US Treasuries. They do have their idiosyncratic factors. What we've been seeing in the sell-off in the long end gilts in the UK has been more about this leadership challenge, this political instability, and the idea that Andy Durham, if he comes in, is set to change the fiscal rules. He said it hasn't happened, so we saw a good buying coming through in UK gilts. Japan's another situation. I mean, we saw big selling in the 30-year JGBs yesterday on the open, and the idea was that we were going to see a new supplementary budget from the new Prime Minister. She mentioned that throughout the day, but we just don't know the exact scale of the additional funding that's needed to be happening. But JGB yields were up very, very high, up about 19 basis points at one stage, and the flow-on effect into US Treasuries was there. Now, I think that's the bigger issue, is what happens with long-end US Treasuries. But obviously there are different factors playing through. But there has been a lot of talk as to the idea of US Treasury yields higher. What does that mean for present value if you're using that as a discounting factor? Why are US Treasury yields higher? It's right tail forces, and should risk be lower as a result of that situation? So we'll have to see, but a bit of reversal coming through in fixed income, but we're certainly not out of the woods by any means.
I mean, overall though, do you see the bond market essentially signalling that the war in Iran is going to deliver lasting inflationary shocks at this point?
Well, I think that's the case, absolutely. I mean, we're not just talking about energy prices here. I mean, I think what really needs to happen now is food as well, food and agricultural commodities, because there's obviously a lag-on effect there with yields and the seasonal factors of harvests, and that needs to play through. That's not dynamic. That takes place on a seasonal basis. So we are still expecting food prices to continue going, but inflation expectations, if you have a look at short-term inflation expectations, 1 year and 2 year inflation swaps, they've come off a little bit, but they're making new highs. And if you look at the front end of the Treasury curve, the market is now pricing the first rate hike from the Fed to be in January of next year. 1 year forward rates were trading at just above 4% yesterday, so that was really pushing up the front end. And then you've got this idea of term premium, which is this idea in fixed income. If you're going to hold short-term debt and roll it into 10 years, what's the compensation you want for the risk of holding those bonds? And that started to rise, and that's not a good thing for equities at all. So I think you are seeing the market saying that inflation is going to be sticky, if they're not actually going to increase from here. And that means that the Fed are going to have to, probably their next move is certainly in the market's eyes and out of consensus relative to economists, the next one is going to be a hike. And obviously the longer this goes on for, the longer that the Straits of Hormuz stays curtailed, then the more those pressures are going to build. And is there a disconnect between the market, the equity market, and what we're seeing from the bond market? Well, perhaps there is, but a lot of the equity market, of course, has been buoyed up by what's happening in the AI scene. Most of the growth in the US is coming from capex spend. So there is a disconnect between the two, but certainly the bond market is screaming out at the moment. Certainly the long end, the inflation is going to stay for a while. It's going to be sticky. The next move from central banks is hiking, and should risk be a little bit lower on the back of that.
But does there remain some doubt of whether the Fed would actually hike, given we'll now have Kemmer Walsh at the helm, and obviously got that political pressure?
Absolutely. I mean, it's a great question. And yeah, look, obviously he's not going to be coming in and doing anything straight away. I mean, the idea of cutting rates anytime soon, given the dynamics we're seeing, is obviously off the table. You don't want to be poking that bear any more than it is at the moment. So yeah, if he comes out and starts trying to corral the rest of the voters into cutting rates, which is a big if, of course, he is just one vote, but he has that sort of talisman effect of trying to get everyone on board with a similar view. There's no way he's going to be able to do that in this current dynamics with inflation moving higher, the labour market okay, and we're going into fiscal spending with the midterms and various factors as well. So yeah, that's not going to happen. But yeah, obviously, if he comes in straight away and signals that he wants to hike as well, I mean, yeah, then he sort of runs the risk of going down the same treatment that we saw from Jay Powell in that situation. That doesn't want to happen anytime soon. So the best case is we're going to see the Fed very much sitting on their hands for a long period of time. And if you look at interest rate swaps, they're pricing the first hike in January of next year. Now, the question is can that build? Can the expectations for 2027 rate hikes build? Yes. And then the second kicker is, will we see that market pricing perhaps come in towards the Q4 period? And that would have an effect, I think, on the US dollar. Equity markets, I think, would have to wear a higher risk premium. So at the moment, markets are saying Fed's on hold for the rest of 2026, which makes sense. But the next move in 2027 will be a hike. The question then becomes, for risk, is will that market pricing, if the catalysts are there, move towards more hikes in 2027, and or as soon a start date, perhaps in the latter months of this year.
So, Chris, what are your expectations for the Asian session?
Oh, it's green on screen. We're looking for that. Obviously, where crude goes, the equity market does the opposite. So, crude lower, equities higher. That's the first derivative. So we should take some relief from that situation. We'll be watching Japan very closely again, just watching their bond markets. And again, you're going to be looking at a lot of these AI stocks, memory stocks. We've got Nvidia reporting tomorrow night. Do we have the kicker to try and drive that one higher? That's going to be a big risk for this week. I think it's going to be a positive open, but it's going to be a difficult one to see people really sticking money to work in this market, because the same forces are there. We've got some headlines that Trump has delayed possible invasion or attack on Iran, but they're still in the mix. And the crude price is so whippy at the moment that no one really buys the idea that we're going to get a sustained move lower anytime soon. So with the inflation backdrop we've got at the moment, with where bonds are, it just doesn't feel to me that this is conducive of a strong flow on effect and a time when you're going to put serious cash to work in the market today.